Perfect. Okay, we are live. Hi, everybody. My name is Stephanie Wolfe. I am the Executive Vice President and Head of Marketing here at Global X, and I am joined by Tony Dong and Brooke Thackeray here today. Super excited to talk to you all about commodities. Before we jump into the AMA today, I'm going to hand it over to both of these gentlemen to go ahead and introduce themselves to you.
Hi, I'm Brooke Thackeray with Global X. I'm a research analyst. I work with the seasonal rotation ETF, ticker symbol HAC. I also look after a lot of the commodities as far as dealing with the media and write different articles on it. So it's definitely an area of interest to me. I'm really looking forward to today.
So I'm Tony Don. I own ETF portfolio blueprint.com. It's my personal blog that covers both the Canadian and the US ETF industries. On the US side, my primary role is as the lead ETF analyst for ETF Central, which is a partnership between Track Insight, a financial data platform, and the New York Stock Exchange. You might have seen some of my articles on publications such as US News and World Report, Kiplinger, The Motley Fool, 24/7 Wall Street. On the Canadian side, I do also write for Money Sense. And I have a degree from Columbia in risk management. I'm also a certified ETF advisor through the ETF Institute. And on the side, I homestead in rural British Columbia with a lot of chickens and goats.
Which I think we're definitely going to get to, Tony, because that is very exciting. But for now, we're going to keep it focused on commodities. So why don't we kickstart things? You know, precious metals, especially gold and silver, have really been a strong theme over the last 6 months. And industrial metals like copper, they remain tied to economic growth in China. So commodities overall are increasingly influenced by energy transition demand and central bank buying. Speaking of central banks, today the Bank of Canada decided to hold rates steady. Now, question on that, we might as well kick things off. Does the Bank of Canada rate hold usually move the Canadian dollar enough to impact commodity prices, knowing that most commodity prices are in USD? But does a weaker or stronger Canadian dollar matter for Canadian producers?
Well, the way I look at this is that it's all about inflation. So the Bank of Canada today had to hold because inflation is still high in Canada, and it's showing a lack of movement lower. And this is the big concern. So we're seeing inflation really being sticky at this point, and we're talking about perhaps some potential rate hikes down the road. So what does this have to do with commodities? Because commodities are part of that, and commodities actually provide a really good inflation hedge over the long term. Better than the stock market as well. So we've seen inflation expectations picking up over the last while, and we've seen in general, of course, there are some exceptions, but commodities actually doing quite well.
Tony, anything you want to add to that?
Yeah, so it's important to note that the Bank of Canada doesn't really have the dual mandate of the U.S. Federal Reserve, whereas the U.S. Federal Reserve wants to balance both maximum employment and a stable long-term inflation rate of 2%. The Bank of Canada really is only focused on inflation. And the other thing to remember here is that the Canadian dollar is primarily a commodity currency. If you think about all of our domestic energy producers and explorers that export that around the world, including to our biggest trade partner, which is the U.S., well, fluctuations in the Canadian US dollar will have an effect there. It's not a direct one-to-one causative effect. There's a lot of different inputs feeding into there. But in general, I think one rule that we can expect is that when around these rate announcements, you might see more volatility around currency pairs. And especially when it's timed during the middle of a global geopolitical crisis around the Strait of Hormuz, you may also see some volatility in commodity. So it's not a directly, this is up, this is also going to be up relationship. But when one moves, you might want to keep an eye on the others.
Yeah, actually, Tony, that's a really good point. It's been interesting recently because we've seen the price of oil moving higher with what's happening in the Strait of Hormuz, but the Canadian dollar has been moving lower. So, it's not always happening. It's not always tied quite that way because there's other concerns going on. We're seeing the US dollar increase in strength and some geopolitical risks. So we're seeing this attractiveness back to the US dollar, but definitely the Canadian dollar is considered, traditionally a petrocurrency, more tied to oil than anything else.
So in energy prices, I mean, this is a big part of the conversation too, right? They were a big driver before. We have seen that energy markets have stabilized somewhat when we're looking at oil, because oil's been stuck at that $70 to $90 range for a few months. So what do you think is going to break it out of this range? Is the OPEC cuts, stronger global growth, something else?
Well, I would say in this case, the biggest thing right now is the Middle East war that's going on. It's that's going to be the big factor here, driving the price of oil much higher or much lower over the next while. And there's two camps on this. I find it really, really interesting because we've lost 1.5 billion barrels of oil with the Strait of Hormuz being closed, and we can't just flick a switch and all of a sudden that just the oil's there and on ships. There's been infrastructure that's damaged. There's oil that hasn't been shipped. We've been depleting inventories. I don't think investors have really taken this quite seriously enough. I really do. I think that we're focusing so much on other things like technology, AI, and IPOs, et cetera, that the focus hasn't been on what's happening. So we're seeing the price of oil really trade in this range. But if the Strait of Hormuz continues to be closed, we could see the oil price really move up quite a bit higher from here. And that's a risk. I don't think the market price is in everything, but I don't think from my standpoint that it is fully priced in that risk, because every day we hear, oh, the war's about to end. And then no, it's not going to end. And then yes, it's going to end. And so investors are just tuned out of all that. And we're in for a wall. If we continue to only have, well, we've lost about $20 billion of oil a day. Well, some of it is being shipped out. So let's call it, $12 billion, 12 million barrels of oil a day that are not being shipped through the Strait of Hormuz. That's a huge, huge, huge factor. And that, if that continues, will just drive the price much, much higher.
I'd agree with most of that. The supply side destruction is unprecedented. And when you look at how countries around the world are very quickly draining or have drained their petroleum reserves, particularly the US, I think people really underestimate the time it takes these second order effects to show up in the economy, right? It's not just at the pump. All those trucks transporting your produce around the country, they're going to feel the effects of higher oil prices, and they'll pass that down to the consumer as well. You see it in aviation, you'll see it in manufacturing, you'll see it in agriculture. It's not just oil that's been disrupted. The supply of urea, for instance, a very important agricultural input, also goes through that strait. The complete diametric opposite of what we're experiencing right now would have been during the demand side destruction during the COVID-19 pandemic from the lockdowns. You remember oil went negative on that. I don't think it's that far-fetched to think that we'll see a spike in oil prices too. I think recently a lot of people, it's been a very crowded trade. People have taken profit from it. But like Brooke said, the underlying dynamics haven't changed. All those millions of barrels of oil that aren't in production anymore, that isn't going to go anywhere. That deficit is cumulative.
Now, we were talking about how it has been quite stagnant, or it's holding steady for some time, though. If you both are in alignment that prices are going to be impacted quite severely, do you have an estimated timeline of what you think that could be?
From my standpoint, I think this is going to be in a couple of months. We see the Strait of Hormuz being closed because, as Tony said, we're depleting inventories really, really fast. And at some point, there's going to be a realization that, yeah, we're in trouble. So if we continue with the Strait of Hormuz being closed, and even if it's open tomorrow, we're still going to have some problems down the road because of that 1.5 billion barrels of oil that's been lost. So I think the music starts to stop in a couple months' time from here. So I'm not talking about it next year or the year after. I think that we're going to face some difficulty in two or 3 months from now if this continues. And even if the war ends and the Strait of Hormuz is open, we're still going to have some difficulties.
Yeah, I would agree too. It's going to be a bit more segmented by which economies around the world you are. For instance, if you're in energy import dependent country in an emerging market region such as India, this is going to be much worse for you. Especially if you're in the beginning stages of industrialization where you need those fossil fuels to get your heavy industries going. This is going to affect you worse than countries with sovereign production capabilities such as us and the US, especially in the Permian Basin. Or even countries like Great Britain, they have two of the largest super producers out there. They'll be fine, or as fine as one can be under these circumstances. But I would be very, very interested to see how emerging market economies, especially in Southeast Asia, are going to fare with the supply destruction. And my estimate is that it's not going to be pretty.
Yeah, I mean, they're already doing some sort of rationing, and with cars can drive on certain days, et cetera, just to protect themselves from this. And as far as Western countries goes, I think Australia is probably another country that could be in trouble as well, just due to the fact that they've actually offshore their refining capacity, and they've struggled so far, and they've been receiving some emergency supplies, but there's a whole host of things. Tony mentioned urea. It goes down the list, though. It's helium that's being used to produce semiconductors. It's also sulfur, right, which is made for sulfuric acid, which you need for copper. So this is a whole loop of stuff, because sulfuric acid is one of the processes you actually make for copper. And if you can't get enough of that, well, you can't really refine copper. Guess what's happening to copper price recently? We've seen copper do extremely well. And that's one of the reasons that's taking place, is being bid up in this type of market here. So it's not just about oil. It's not just about natural gas. It's about fertilizer. It's about, chemical elements. It's about diesel. All of these. And so the commodity sector overall is being affected by what's taking place here.
Absolutely. Well, actually, why don't we switch gears for a minute, because you were just talking about copper, and I think that's a really important element. I mean, the price has been all over the place this year. Is the long-term electrification / AI demand story still intact, or is the China slowdown fears the bigger driver right now with the price of copper?
I'll let you go ahead with that, Tony. Start that one off.
Yeah, so these two forces are going to work against each other. And it's one thing investors need to understand is that when you map out the kinds of pressures on a commodity, it's not just like a simple this and or that relationship. Sometimes they can offset, sometimes they can amplify each other. And this is one of those things where, yeah, if the Chinese economy slows down, but we have simultaneously a very large demand for electrification from the US, it's going to be hard to model that out, to put it blankly. I think that both of these are valid, but if you think about it, only one is long-term. The AI build-out and the CapEx demands are going to be sustained. It's hundreds of billions of dollars over the next few years, a lot of commitment from various consortiums that are backing this. Whereas a Chinese industrial slowdown, that is really a short-term cyclical story. Economies ebb and flow. You go through booms and recessions. Now this might be the downtrend, and that's part of the course for a cyclical story. So I would say in the near term, I'm concerned about short-term volatility in copper prices, but long-term, you look at all the forecasts from the IEA, from S&P Global, that demand for copper isn't going anywhere. So at this point, I would be focusing more on the miners, looking at their all-in sustaining costs and looking at whether or not there's any pressure on their margins right now from that slowdown in China. And it's useful to, look into financial statements, break down, break it down line by line, like how much of it is from this particular economy, what is it used for, how much of it is just a byproduct of mining for precious metals. These are things that you should be looking at before even considering an investment in copper.
Right.
Yeah.
I just want to, sorry, Brooke, before you answer, not financial advice. We just have to make that call out here as we're on YouTube and Reddit. So go ahead, Brooke.
Of course, yeah. No, Tony's right. There are multiple cycles working here, and copper has been called Dr. Copper in the past because it was an indicator about the economic health, because it was measured in what's happening with the overall GDP expansion globally. If we saw strong growth, we'd see demand for copper pick up, and it would do well. And likewise, if we saw a recession, we'd actually see it pull back. And it became known as Dr. Copper. But that's because copper was used in things like building houses and industrial plants, et cetera. That dynamic's all changed now. As Tony said, we got hyperscalers out there that, we're data centers. And it's not just, what's in a data center? Some wiring there. It's all about building the grid for that as well. Huge amounts of demand for copper on a go-forward basis. So that structural play is huge. And if you take a look at the supply demand, where we are right now, we're in balance right now, but the deficits they're going to build in copper up until 2040 are going to be absolutely huge. We know the demand scenario, and we know the supply. And the thing is you can't just flick a switch. This is all with all commodities. You can't flick a switch and go, oh, we need more copper, let's just go get it. It takes 10 to 15 years sometimes to build a copper mine. And how many big copper mines have we developed in the last few years? None. It's just, so we're behind the ball on the supply side, and it's a huge, huge problem. And demand is going to continue to grow, and we're going to start to see those deficits start to happen starting next year and continue to grow out until 2040. And that's a huge problem that just hasn't been realized yet. And so I think from an investment standpoint, copper over the longer term looks really good. But in the shorter term, you are going to see some movements with that Dr. Copper phenomenon with the economy, but long-term fundamentals are going to be very important here.
So on that, and Tony, I don't know if you're comfortable answering this. I mean, when we look at those long-term fundamentals, what advice would you give to investors if they're looking to choose commodities into their portfolio? What should they be looking for?
Yeah, I think too many investors focus on the potential, the more minor specific ones, such as their all-in sustaining costs, their debt load. But I think there's a case for starting with risk. And a big part of investing in copper miners and any miners is political risk, right? A lot of these companies, even though they may be domiciled in developed countries such as Canada, the US, Australia, a lot of their projects are in emerging markets. And some of these, there is a serious risk of conflict, of nationalization, or of outright expropriations. And that is an example of operational risk that you are really not compensated for, right? Many of these companies will disclose it in their 10K or their 10Q, but sometimes, like for those newer exploration projects, it might not be updated in the quarter yet. So it's a good idea to follow along on the press updates and do your own research, right? Go look at the government of Canada manages travel advisories for a lot of these countries. That's a good place to start to look at the political situation, see if there's any armed military conflict, see if the government is pro-investment or not. If you think about what happened with Venezuela before the Trump administration basically couped them, right? There was a large history of nationalization and expropriations there, which has made many of the super majors, even those currently operating there like Chevron, very, very skittish about large-scale capital investments. And as an investor, that kind of uncertainty is the kind of stuff that you're really not paid for.
That's right. Good points, Tony. And again, not investment advice, just some great tips for you to take a look at some of those fundamentals. Okay, I'm going to switch gears here for a second because we have a few questions that have come in from Reddit. We did a poll and we were asking investors what it is that they would like to hear about. What came in the top three was uranium, silver, and energy. So we have touched a little bit on energy, but we haven't even delved into uranium or silver. So why don't we talk about silver, or talk about uranium actually, for a couple of minutes here. There has been a huge run on uranium in the last couple of years. Now, we were talking about an energy deficit. So do we see this as a nuclear renaissance that's actually driving demand, or is this mostly a supply squeeze and speculation?
No, there's a renaissance taking place. It's huge. What we've seen really is, nuclear not that long ago was not considered to be green energy. In fact, in 2022, the EU was trying to fine France for not being green enough because they didn't include their nuclear power. That was the standpoint, and that all changed. We went back and forth, and then we saw COP28 come out in Dubai take place, and all of a sudden now you saw nuclear being recognized as a green energy. And because countries woke up and said, look, we can't just have renewables here as a baseload supply. And so now we're seeing it all in on nuclear power from all countries across the world. Even Germany, which was really staunch against uranium and nuclear power for a long time, just recently, a month ago, came out and said, we made a mistake. We shouldn't have stopped nuclear. They basically stopped their whole nuclear program, took down the nuclear power plants. Countries around the world now have committed to this, and this is a structural phenomenon that's taking place. So we know the demand going forward. It's just how it's good or great or really good. And we know it's exactly the same problem that we talked about earlier on with copper and the other commodities as well. It takes a long time to bring uranium mining up to speed. It takes a long time to do all this. And so we know the supply, expected supply over the next 30 years. And we see that deficit widening and widening and widening. And this is just math. So strong demand, supply, not very strong. This is all just math. So we will see uranium move up and down in the short term. We see uranium pull back here. Even the spot price currently is about $85. Now, I want to say that investors focus on spot price a lot because that's what's put out in the media a lot. But it's really about the long-term contract, because 80% of the contracts or the supply going into nuclear facilities is long-term contracts. And if you take a look at the long-term contract price, it's been going up every single month for the last while. Cameco just put out their latest price, and it went up again last month from the month before. It's now at $94 a pound. And so that divergence of the long-term contract keeps going up, we're going to find that divergence helping to pull the spot price of uranium up. So the dynamics, long-term fundamentals are really good for uranium, and we're starting to see some good fundamentals to help drive the price higher, even in the short term.
Even though they're elevated right now. So just before you answer, Tony, because I know you probably have something you want to say on this, just a reminder that we are streaming live right now on YouTube and Reddit. So if you do have any questions around commodities, specifically uranium, copper, energy, etc., please enter them through. We are taking them live, and we will ask your questions right here. Okay, Tony, over to you on your comments on uranium.
Yeah, so like Burke said, I think focusing on uranium spot price is for lack of a better word, a rookie mistake, right? It's very exciting. It's quoted live. You can see it go up and down. There's even ways to invest in it using a variety of closed-ended funds. But the build out is what's important there. That multi-decade infrastructure, it's really changed what used to be a very commodity-driven sector into one that's focused on spending, right? And I look at nuclear energy as a national security matter, as a form of energy sovereignty, which we know is going to become more important. Ever since the Ukraine war and ever since this Hormuz thing, it shows you that, relying on fossil fuels means being at the mercy of supply chains and another country's, for lack of a better term again, gumboat diplomacy, to borrow a term from the 1900s, right? So now that we're seeing a resurgence of this, it's important for countries to have their own source of energy. And there's no reason we can't do that in Canada. We're one of the largest producers of yellow cake, down in the prairies. We have one of the largest domestic producers and explorers in Cameco. And a lot, Ontario, OPG, Bruce Power. There's a precedent for having uranium there. And now, the cool thing about that is if you tack on a Brooks point about these long-term contracts and stuff, it very much reminds me of the same dynamics at play in a quasi-utility such as Enbridge, where it's less about the product they move and more about these long-term contractual cash flows they're able to secure. And as an investor, that's something you want to see. When you're investing in a company, that's the benefit over just holding a spot commodity that itself produces no cash flows, doesn't grow earnings, doesn't return money to you in dividends or buybacks.
It's fantastic. Okay, now I have a couple questions that have just come in from Reddit, so we're just going to again switch gears. I have the first question is from questions about cash. Can commodity ETFs be held in a TFSA, FHSA, or RRSP? Brooke, maybe.
I'll let Tony handle that one.
Okay.
Owned in a registered account, it has to be what we call a qualified investment. And for the most part, or virtually all the part, ETFs, especially Canadian ones, are qualified investments. Now, that being said, the commodity ETF itself can have different types of exposures. Some can be synthetic based using futures contracts. Others may hold producer equities and function similarly to a equity ETF, just with more sensitivity to inflation and drivers of commodities such as supply and demand.
Perfect. All right, the next question is from Euspicious Square 912. What is an all-in-one commodity ETF and what does it hold?
So an all-in-one commodity ETF is just like a basket. It's an ETF that can have a representation from different commodities. So it might have gold, it might have silver, agriculture, or copper. Some of the commodities that we've been talking about today, uranium. So commodities tend to be with this really good long-term fundamentals, but you can see some volatility. So instead of just investing in one sector, for instance, gold as an example, you diversify into different commodities. And an all-in-one ETF is trying to do that for you and balance that out as well. I mean, they can have different indexes like the Bloomberg Commodity Index. It might represent different weights and for different reasons. But basically, an all-in-one commodity ETF has different representations for different commodities all in that, which helps to reduce some of that volatility. And so you don't have to pick so much the winners and losers within that commodity in the short term. So it's probably a good way, this is not advice, but I can see this being used for a core product. And then as far as commodities for exposure for the average investor, and then perhaps some specialty or tactical going out and looking at some other ETFs that are singular, like for instance, gold or silver or uranium or whatever it is.
Mm-hmm. Yeah, definitely not financial advice, but It makes sense. I mean, if somebody doesn't have the time to look at the markets every day or the spot prices of what's happening in the markets, this it is probably a good alternative solution. Okay, it looks like we have one more question that just came in from Reddit.
What is the difference of holding a security that is a spot price drive like gold, silver, rather than companies who work in that sector? Which one is better to hold?
Were you able to hear that?
Yeah.
Okay.
There's usually set through one or more associations like the LBMA gold price, some of them go through CME. When you own a producer, you have what's called embedded leverage. And that's because while these companies' operating costs may stay fixed over a quarter or so, the commodity price isn't. So even small changes in the spot price can lead to outsized gains in their margins, which translates into higher earnings per share, which translates into magnified moves in the stock price. However, investors need to remember that these are still equities and they come with some market beta, usually outsized. So there's sensitivity to the broader market. So when you own commodity producers, there can be situations where even if the underlying spot price is doing well, if the overall market has a drop, maybe like Trump says something outrageous, or maybe there's another invasion somewhere, that can still fall because you're still taking on market risk. So, for someone, if your goal is to avoid market risk, the spot price makes the most sense. But keep in mind that not all commodities can be accessed through spot exposure. Generally, it's easier for precious metals like gold, silver, palladium, platinum. But as you get more complex, it's kind of hard to store barrels of oil or bushels of wheat, right? Those things degrade, there's cost of transport. And that's where people start looking towards alternative measures of exposure, such as futures contracts, which come with their own complexity. But commodity producers tend to sit in a very accessible middle ground for the majority of investors. And when packaged into an ETF, they retain a lot of that liquidity, but gain the benefits of diversification.
Yeah, and to Tony's point, we've seen situations in the past where the price of oil has gone down and energy companies have actually gone up. And you'd say, well, why is that? And sometimes the dynamic's very different because they have some fundamental market-driven forces that are different. So the oil, when you're looking at the spot price, can be driven by companies around the world needing oil now, right? And energy companies are more levered towards the future because they would have oil in the ground, which is a different dynamic. And so you can find energy companies being more about expectations for the future. So you can find them actually diverging. Generally speaking, if you see oil going up, that's going to help boost the energy companies. And as Tony said, though, you have market beta. So if the market's going down at this time, like the broad market's going down and there's a lot of sell-offs taking place, you still could see energy companies going down despite the price of oil rising. So there are some differences that way.
Mm-hmm. Well, I think you both did a really great job of explaining that with some real-life examples there. So I am going to switch gears again because, like I said, we did have the poll on YouTube. I think it might still be live. And we did talk a little bit about uranium, but silver was actually something that people wanted to talk about a little bit more. Obviously, we can talk about gold. Gold has been a clear leader this year with pushing to all-time highs that we've seen. We've seen persistent geopolitical risk, strong central bank buying, and the expectations for lower global interest rates. And silver's catching up, right? It's been rallying lately. And is this more about it catching up to gold or the industrial demand side with solar and electrification finally kicking in? Tony, maybe you want to answer that first, or Brooke?
I'll take this first.
Okay.
So one of the ratios that I think a lot of silver investors look at is the silver to gold ratio. And for much of the last decade, it was pretty low. Now that's changed lately. I think that there's two drivers behind this. The most obvious one is the ongoing debasement of the US dollar. Silver prices are higher because the US dollar is commensurately worth far less than it was a decade ago. During the same time, we've seen the federal deficit continue to increase. We've seen M2, so money supply, continually grow as well. So investors are looking for alternatives to keep their cash safe while earning some sort of a return above inflation. Gold is one of them, but silver is attractive because the market is pretty big. There's a lot of exchange traded products available for it, and psychologically, it's at a lower price. People like that. It's the same reason why when a company splits into fractional shares, nothing has economically changed, but you tend to see more trading activity around there. the industrial side is important, but it gets glossed over a lot because nobody realizes how it is. There are tons of silver in my room. The light switches, contacts are silver, my binoculars, it's all around you. There is a lot of demand too from alternative energy sources, solar panels in particular, and also the data center build out. If you thought copper is important, silver, thanks to how malleable and conductive it is, has almost as important of a role. And a lot of people don't realize that there's not a lot of pure play silver miners out there. By far and large, it is a byproduct of mining for gold. So that dynamic makes it, at least for me, something to always keep an eye on in the periphery.
Well, actually, on that, and before you jump in, Brooke, sorry, I am going to ask a quick question here that came in from Fig Scary 6343. What is the difference between investing in silver miners and physical silver? Because you were just speaking about the.
Sure.
Yeah. So,
oh, go ahead. No, go ahead. It's fine.
but fluctuating commodity prices, that's going to create outsized moves in their margins and EPS and thus stock price. So all else being equal, again, because they're still subject to market risk, they're going to be more sensitive up and down to commodity prices. But unlike spot silver, silver producers produce earnings. They're earning cash flow. And some of them, although the dividends are not high because their CapEx requirements are so much, they're able to pass along some of that cash flow. And I wanted to highlight silver streamers in particular, companies like Franco-Nevada and Wheaton Precious Metals that aren't actually mining for silver, but they're providing financing to silver companies purchasing the rights to their future production at a discount price and then selling that in the market. And that's kind of more of a high margin capital light way of gaining silver exposure. So you got to be really careful with some of these companies in there. You got silver miners, which are very leveraged. You got silver streamers, which are a bit more asset light. And then you have junior silver miners that in many cases have no earnings and they're just exploring new deposits. They're prospecting. These are very high risk. So to bring it back to my point, there's an incredible amount of variety in silver equities. Make sure you define what you're looking at first, because that will affect their relationship to spot silver prices.
Yeah, and what you find too, though, is sometimes a good way to think about silver miners compared to silver. Silver miners actually have silver in the ground. So you're buying that silver for the future, and then there's operational risk that goes with that to get it out of the ground, of course, and geopolitical risk that goes with that at the same time. But they are producing money. So there's room for both in portfolios because they are different. And yes, if silver goes up a lot, you're going to find. And so the best combination for silver miners would be a situation where you've got the market moving up and silver price moving up. When you got those two factors really happening, you find silver miners tend to do really well. And now, as far as junior miners go, we haven't seen this real attraction to junior miners in the markets for years because the focus is in other parts of the market. But we might see that as commodities do well in the future, but you have to be extremely careful in that area, particularly because a lot of these don't have cash flow and they're really just starting off here. So it's just an area of concern.
Yeah, agree. And again, just a reminder that this is not financial advice. It looks like we do have another question that just came in, and I will get it here.
All-in-one commodity gives you exposure to all, but wouldn't it be better to hold 3 to 4 separate ones? That way you can at least sell the winners and losers, whereas in an all-in-one you might not get that.
Did you guys hear that? What do you think is better?
What are you looking for in terms of your objectives, right? If you're a tactical trader who's attempting to speculate on commodity prices, yeah, an all-in-one commodity ETF might be too general. But I look at it from a portfolio perspective. From that angle, I want an asset that has different drivers than stocks or bonds. Stocks are driven by earnings growth and shareholder return programs like buybacks and dividends. Bonds are driven by things like credit conditions and central bank interest rate changes. Commodities are driven by inflation, supply, and demand. So you are looking for exposure to different drivers of risk and return. And the implication of that is that all else being equal, these commodities could be less correlated to what an investor usually holds in a balanced portfolio. Think about 60-40 stocks and bonds. In that case, if your view is long-term strategic asset allocation, an all-in-one commodity ETF provides you the simplest solution for rebalancing, for diversification, Whereas a single commodity, you're introducing more idiosyncratic risk. Think about the risk specific to the gold market or the oil market. You're not really compensated for those. By pooling it out between various different commodities, you retain the underlying structural benefits of inflation sensitivity while hedging a lot against these. So that's my angle on it. Again, always determine, are you in it for the short term or long term? Are you in it for a portfolio or for a trade, right?
Yeah, so there's nothing wrong with actually owning both, but for different reasons. So there is no one specific solution. I believe that an all-in-one commodity index is probably good for a core position for a lot of investors. And then there's some tactical and say, well, I really believe this is happening long-term in uranium, that I really have my conviction for that. Perhaps then you can make a oversized weighting in that particular sector based upon the core, but it's not like one only. So it depends on how you're doing things with an operation, but for most investors, it's probably best from a structural standpoint, risk standpoint, to take away that idiosyncratic risk by having some sort of all-in-one commodity and then going off and acquiring one or two others on different weights that you believe is appropriate for the situation.
That's right. Well, good answers. And again, not financial advice, but really is up to the individual investor based on their risk tolerance, time horizon, and investment goals as well. Okay, so I think we've got a few more questions that have come in from Reddit. Now, I don't know, Tony, if many people know that you live on a homestead. If they follow you on LinkedIn, they will know that you live with an array of wild animals. And I have a question here from Reddit asking, what is more unpredictable, commodity markets or three goats? And what are your three goats' names again?
Buttercup, Peanut, and Cookie. Goats are super predictable. They're creatures of routine. They like people. They like food. They hate predators. So if you understand those drives, you can hurt them pretty effectively. I think shepherding is one of the oldest professions, and it was pretty easy for me once I got them. They literally follow you around. Commodities are a completely different beast. I'm not sure if anybody listening to this has ever heard of the term widowmaker. Very common for traders who trade natural gas futures. In fact, if you look at James Cordier, Cordier, very infamous apology video where he used to manage a hedge fund, got blown up trading natural gas futures, lost all his clients' money. So this is a professional options trader that lost his shirt literally on commodities. So if I had to, yeah, commodities are way more unpredictable than goats. Technically, goats are a commodity. Livestock futures do exist.
They do. Brooke, I don't know if you have any animals in your life, but
No, I can't compete with Tony on that one.
yeah, there's quite a few. Okay, so we've got another couple questions here. One from Apprehensive Let 447. How does a uranium covered call strategy work? And there's a rooster. Right?
Oh, I hear the rooster. Yeah. Now, what's the name of the rooster?
Sunny.
Sunny. Okay. Oh, because the sun comes up. Yeah. Okay. Yeah. A cover call ETFs basically is you're owning the underlying security, and then you're writing calls on it. And you can own different amounts or write calls on different amounts of the underlying. And you can go out and say, well, I want to write at the money or out of the money. There's different ways of actually doing it. So what you're looking for is to somehow develop an income stream because you're selling calls. So you're going to get that money back from that. And so that helps reduce the risk, generally speaking. There's other types of risk involved as well. But in certain environments, that can be a very good way of actually owning that segment of the market. And there are some risks. For instance, if you owned covered call ETF on semiconductors and you're just outside the money and semiconductors go up a lot, then you can get called away and then you lose some of that upside benefit as well. But generally speaking, covered call ETFs have been popular with investors because they're largely made to produce an income stream from writing the calls with the premiums.
Is there anything else, Tony, that you wanted to add to that, or I think we're...
Yeah, I would say covered call ETFs can vary a lot in how they're constructed. And three things you want to look out for are how aggressively they overwrite the portfolio. So are they selling calls on 100%, 50%, 33%? Because that will impact how much premium you get versus how much upside is capped. On that note, strike selection also matters. Like Brooke said, writing at the money, so setting a strike price that is at the market price of the security will give you the most premium. But your upside is almost completely eliminated, where selling out of the money will let you retain more upside and so forth. And there's also how long you write out to expiry. So in the US, we see a lot of covered call ETFs that will mechanically sell the same 1 month call every month out and roll it. But you don't have to sell monthly. You can sell weekly. There's even daily. You can sell longer. The thing to understand is you can think of all these as 3 levers you can push and pull on to adjust your risk and return. And an active approach in a covered call ETF allows the managers to vary these based on market conditions. It's a bit more dynamic than just say, okay, I'm going to write at the money 1 month and 100% of the portfolio each and out and out. And another thing to note is that the underlying can differ as well. You can write covered calls on indices, you can write covered calls on specific ETFs that have enough of an options chain, or you can write covered calls on individual names. So all in all, these give ETF managers a tremendous amount of flexibility in how they structure a covered call and the risk and return. But as an investor, it's important for you to dig deep into the prospectus to understand what kind of strategies are they using and keep up to date with the body of research that comes out with it.
Mm-hmm. So if we had to summarize this, what are the top 3 things that investors should be looking for if they're going to be seeking a commodities or uranium covered call ETF? You want to...
Strike price, overwrite amount on the portfolio, and time to expiry. So these are the things that will basically determine the risk and return of an options writing program. And of course, you got to be comfortable with the underlying. Using a covered call strategy means being long the security, but with a more muted view on price appreciation. So it's suitable for investors who are okay with capped upside, want the income now, but still want some degree of exposure. But one thing to note is that covered calls are not a perfect market hedge. The premium you receive can offset some volatility, but it's not going to work the same way as, say, a put option would, right? You still retain a good amount of the downside there. So again, you have to be comfortable owning what the ETF actually holds.
And understand how they work. Brooke, anything else to add before we move on?
Read the prospectus. How's that?
That's perfect. Yeah,
as we always say in the bolded headlines. Yeah, I think it's really, really important to understand the covered call ETF. As Tony said, they're very different in the risk structure of what they're doing and how they're doing it, and they're not all the same. And just don't look at the yield. Just don't go, oh, there's the yield that they're putting out right now. It's important, but if the yield's really high, but maybe they're making a return of capital as well at the same time, because that's the only way they can do that. So, and then that's where investors don't understand. With the return of capital, they see their asset going down over time because the yield's really high. So they're getting that payment for the yield from their capital themselves. So you have to understand the product as much as possible. And as I said, read the prospectus.
Agree. Okay, and again, just another reminder, not financial advice. And if you do have any questions, please drop them live on YouTube or Reddit in the question box. We have about 10 more minutes here going in, and I don't want to miss it. We really haven't had a chance to talk about gold. I think we could. So maybe I have a question here from Reddit. Buffy Misty has asked, will gold value drop more, or should we buy now? So that's
okay. Not financial advice, and
not financial advice.
And should we buy now? I mean, I'm not going to say that's really comes down to individual circumstances and the portfolio and everything else. But I can talk about gold generally speaking and what's happening, and it had a strong run up. And earlier in the show, Tony was mentioning about currency debasement taking place, and that was a strong narrative and for a while, and that drove up the price of gold. Particularly because we saw central banks buying a lot of gold. And that's really been the key driver since 2022. We've seen central banks buy it up. We've also seen a lot of interest from, and that's mainly Eastern, the Asian central banks and Eastern central banks that have been buying it.
China's really been.
China's been really big. It's even countries like Poland, Turkey, like just not Western central banks, like Canada, as an example. Just as a fun fact, Canada and its reserves has 0 gold. Most people don't know that. Yeah. So we've seen that phenomenon taking place, and also the retail investors in Asia were also big buyers of gold at the same time. And so that really drove the price higher. In North America, we saw it making headlines a lot because it was going up every single day, for a while, and ups and downs, but it was going up a lot. And, despite that, investors still weren't going into that because the average allocation for a portfolio, a few decades ago was around 9% for gold in a portfolio. Now it's less than 2%. So investors haven't been interested, and they just haven't been buying. And there's a couple of ways I measure that. One is the inventory of gold in the GLD Spider ETF for gold, GLD. And you take a look, its peak really was back in 2020 is how many ounces they held, because when an investor buys a unit of GLD, then that GLD has to go out and buy. And we saw that peaking back in 2020, and then we see it come down. And despite price going up, so price was going up, and the inventory in gold was going down. So what does that tell you? It means that investors in North America were big sellers of gold when the price was rising. It's only recently we've seen some interest. What I'm trying to say is the interest in gold right now has been extremely low, and despite the headlines. And I think it's a narrow door, and when we do see this narrative change, we can see gold do particularly well. And I want to talk about what's happened recently, because I think that's important. We've seen gold pull back here. In fact, today it was down around 3% earlier in the day. So what's happening? And that's really being driven by central banks and investors selling because they need the cash. As an example, Turkey ran into some financial difficulties recently, and we saw a lot of emerging market economies do this. And they've had to sell gold. So they sold 60 tons of gold. And so investors have been doing the same thing. So it's sell what you can sometimes, and not so much the fundamentals. The fundamentals are still there longer term. So we're going to see these ups and downs, and we've seen gold pull back. But the fundamentals are still there over the long term. I still think it's long term still an attractive place to be, because we're still going to see further debasement of currencies. We're still seeing a lot of government spending. We're seeing QE. Federal Reserve has a mini QE program in the States right now. They don't call it QE, but it is QE. Mm-hmm. And so it's not just the States. It's not just Canada. It's Europe too. So we're seeing all of this take place. So I think the long-term fundamentals are still good for gold.
Tony?
Depends on what you measure the price of gold in. If it's in the US dollar, yeah, I think over the next 2 decades, there'll be more dollars in circulation. The US federal debt the debt ceiling will probably be even higher. And, if you think about a kilogram gold bar could buy you a nice house 50 years ago, it'll buy you a similarly nice house today. The only thing that changed was the denominator there, the US dollar. Do I think gold will outperform stocks? Probably not. If you measure gold's price against the S&P 500, they both did inflation hedges, and that again just comes down to what they're denominated in. So if your main concern is a continued erosion of the US dollar, I think long-term gold is going to be one of the more sensible ways to head against that. Central banks are doing it, but short-term, as a reserve asset, you got to realize that the entities that are hoarding this reserve asset reserve the right to dump it. That's the whole point of a reserve asset. It's there if you need it. And that's what we're seeing now when central banks need to raise capital, when they need to shore up their balance sheets. Well, they start looking at things they can get rid of. Okay, it's either treasury bills, their US dollar, which you can't, it's really hard to dump US dollars nowadays, or gold. And there's always a willing buyer for gold. It's a universal medium of transaction. When people talk about cryptocurrencies being that, people have been exchanging gold forever. Roman centurions used to be paid at it. And when trust in fiat breaks down, it always goes back to gold. So short-term volatility is part of the course for a commodity. And you got to really make that distinction for your risk tolerance and your time horizon ahead of time, because the last thing you want is to go in for a quick in and out trade and end up holding this for 10 years. So always set that up front, be realistic with yourself, and do your research.
Mm-hmm. Agree. Again, not financial advice, but good tips here. Now, we do have one more question, which we sort of addressed earlier on. We were talking about why silver's been rallying and the popularity there, but since we're on the topic of gold, the question comes from Express Individual 77. Why is silver gaining so much popularity? Again, maybe just a quick recap, because we did mostly address this earlier on.
It's a catch-up trade. Yeah. It's, gold, I see it as kind of a cascading effect. Gold gets the attention first, then it gets crowded. People move to silver, it gets crowded. You go to copper, palladium, platinum. I'm seeing interest in lithium and cobalt now. Mm-hmm. So, it's against the debasement narrative. You're looking for alternatives to the US dollar, and then that generally goes in order of market size and then liquidity. Gold is very liquid and there's a lot of it. Silver comes next. And now you just start working your way down. Investors like to herd. Investors are herd animals, to put it bluntly. They like to crowd trades. Some trades get very crowded, and then they unwind and they move on to the next one. Follow the liquidity.
Perfect. Anything else you wanted to add to that, Brooke? We haven't touched upon with silver.
Yeah, with silver, it has been more volatile than gold, and it typically is more volatile than gold. It's different than gold in the sense that it's also an industrial metal, primarily an industrial metal. It has had more interest from the investors recently, and we've seen liquidity in silver, although it's good, it's not nearly as strong as gold. And central banks in general do not own any silver. They used to a long time ago, but they don't today. So silver, from that perspective, the dynamics about what's driving the silver price is different. And it's a narrower market, so it can get squeezed higher. We saw that back when GameStop got squeezed higher. That 140% of the float was shorted. And so there's a squeeze that was put on those investors to push it higher. And they tried the same thing in silver just shortly after that. And we saw silver spike up a little bit and then come back down. The market was just a little bit too big for that. But silver still, when the central banks or the government start getting involved here, still is not as very extremely liquid. So we can see it actually move up and down more than gold itself. And we've seen silver pull back here as well. It hasn't lost its industrial use. In fact, it's been gaining industrial use recently because some companies are trying to use it for solid state batteries, et cetera. So the prospects for silver on the long-term basis are extremely strong. But investors should expect silver to be more volatile. I think silver can still be an extremely exciting opportunity down the road, particularly because if the narrative comes back to being very positive for precious metals, that really could push silver much higher from here.
Interesting. Thank you for that. I was going to get into the difference between silver miners and physical silver, but I can hear Sunny back there, and I'm looking at the time. So I think maybe what we're going to do is we are going to throw it back to you guys. If there's any final comments or things that you would share with the audience around commodities that they should be thinking about as we move into the second half of 2026, what's top of mind and what do you think they should be paying attention to?
Tony, I'll let you lead there.
Emerging markets. And the reason is that a lot of investors tend to underweight these in their portfolios, and that's just a function of the kind of indices that you're owning. If you look at your typical all-in-one asset allocation ETFs, weighted by market cap, so after the Canadian home country buys, there's not a lot to emerging markets there. I don't know if that's going to be good or bad, but I do know that the outsized impacts of the supply destruction that we've seen so far are going to be disproportionately reflected in these economies. Again, net importer of energy, weaker supply chain, security, and a lot of these are very close to the affected areas we're seeing right now. Their economies are in the stages of industrializing and technologically advancing. That requires a lot of energy demand, of which much of it is still in fossil fuels, not just oil or gas, but actually coal. And what people don't realize is that year to date, these economies have been sharply driving performance, particularly tech centers in regions like Taiwan and South Korea. Again, neither of these have oil reserves or oil production the same way we do in Canada. Yet if you look at the second order effects, oil is constrained here. These chip manufacturers need oil, need energy to do so. That disconnect is going to reflect sooner or later. And after seeing valuations go up, I can't help but notice that we haven't really seen the negative effects of these supply shocks yet. So I'm keeping an eye on when they'll show up and how they'll pressure valuations for these companies. So personally, I'm looking at management commentary, I'm looking at 10Qs, I'm looking at industry keynotes where their executives are speaking. Energy affects everything. So if you're just listening to what the super majors and the miners and producers are saying, you could be missing out a lot of the conversation around these second order effects. And if you're going to be a serious commodity investor, this is the kind of research that should be done.
Yeah, I just want to finish up by talking about something that we didn't talk very much about, and that's the commodity super cycle. It's the term you're hearing more and more right now. Mm-hmm. And I think we're actually, at the beginning stages of that. And of course, there's going to be some ups and downs, but I think we're at a generational opportunity for commodities overall. Let's go back and take a look at the last commodity super cycle, which was from 2002 to 2007. Well, what happened? Well, let's take one step further back and take a look at the markets in 1999, a long time ago. And I got to tell you, that was the tech bubble at the time. I'm not saying basically on technology. Nobody else wanted to invest in anything else. Nobody's interested in oil. Nobody's interested in uranium. It's all about technology. That was it. And when the tech bubble broke, we saw that happen in 2000, start to break, and then down to 2001. And then we saw investors all of a sudden turn around and go, what? We don't have enough potash? What? We don't have enough uranium? Yeah, we never had enough. We just ignored it. And I think that's where we are today, right now. We're in that situation where the AI tech is sucking the oxygen out of the room for everything else. And we've got these shortages, whether it's copper, uranium, silver. Silver's on a 6-year shortage. They're all taking place. This is fertile ground for a strong run. And that's why I say that we could really be on the cusp of a commodity super cycle. And that doesn't mean that they won't go down in the short term. But if we look out over the next 5-10 years, the horizon actually looks really good for these commodities across the board. And if you look back in 2002 to 2007, oil did well, uranium did well, gold did well, silver did well. It was across the board for all commodities because we just had that narrative shift. And I think we could be coming into a situation where this could take place once again.
Mm-hmm. Agree. So two very solid closing points. Agree with both of you. I think it's going to be an interesting over the next few years to see how this plays out. Just before we close things off, there was a final poll question that we did have, which is, do you currently own any silver investments? Where it ranked is yes, we have 16% of people coming in with physical silver and people owning 16% with ETFs. Only 5% hold silver miners, and 62% said no exposure to silver today. So that's just what we're looking at in terms of Reddit and where people are thinking about silver right now. But anyway, this was a fantastic discussion around commodities. Thank you both so much for joining us today. Commodity supercycle worked out for energy and emerging prices and seeing where emerging markets and seeing where everything is going. So thank you both. And any last comments before we close out today?
I just want to say thank you very much for this opportunity to participate in this conversation. It was great. Tony, Stephanie, thank you.
Well, thank you both.
Nothing on my end. Position sizing and risk management.